Hey everybody, happy Sunday. It is August 14th. And after what we just went through there on Friday, actually Thursday and Friday, uh, be prepared. We've got OPEX this week, options expiration week, and undoubtedly going back to the pattern that worked for 5 years, we're going higher. We're going higher this week, fractionally higher, likely another 20 points to that 4,300 where there's a gap that I'll show you in a little bit. But speechless as to how I will use the phrase impulsive. The impulsive fifth wave that we're in has been. And I'm literally looking here only at the August data, just at August. And during this month of August, which has been what, call it 9 days, 9 sessions, 10 sessions, 10, yeah, 10, sorry. We have closed above the previous close only 3 times. Yet we are up 4.08% for the month. From the open on August 1st, 41.12.38, we're up 4% on the month, and we've only closed green above the previous close 3 out of the 10 days this month. That's as impulsive as you will ever see. And you need to go back to other impulsive endings like the end of 2021 into the start of 2022, how that fifth wave ended, other ones like back in September and January, specifically January of 2018. Um, but in any case, I just want to run through this data before we go further, just so that you can understand the impact of what we've got here. And, we peaked on the second day of the year. January 4th was when we put in the all-time high. That was the second session of the year. And we bottomed over there at that 36.87 in June, was the 116th session of the year. So it was 115 trading sessions to get down to that 36.87, where at the lows we were down 24.5% on the SPX. We were down greater than 30% over on the NDX, on the NASDAQ. But as you remember, as I kept showing, how this is not the big bear market bottom, scare you to death kind of headline that everybody was pointing out, was the Dow never, ever broke or even touched its bear market minus 20% line. And that's very significant, even though you had the Russell 2000 down almost 40% from the all time highs. That's what happened. And after we put in that low there in June, we started getting these smaller trading ranges where we had a 38, we had a 37, a 33, a 31, a 25, and another 25 this week, and then another 33 this week, lower than 40 points, which was our bare bottom minimum prior to going into that June bottom. And since then, 40 has kind of been more or less still the average. We're still having 80-point days, 60-point days. These are not bull market types of numbers. They're not. I can, in fact, yeah, sure, I will while we're here. 1 second here. Yep. Unhide rows. And here, I'll go back to December, right? Where we were there. Yeah, granted, in December, we were very volatile. As you remember, we came off of that big bottom there in October. But you start going back to last year, go back to August, we were trading, 40 was a big day. 40 was a big day. Usually we were having 15-point days, 20-point days. I don't have the ATR for back then, but I mean, look here in June, we were trading below 20 points a day on average, consistently, where a big day was 50 points. Now, 50 points is kind of a small day, other than what we've got going over here with the Wait, boom, and yeah, they're hidden again. We're still trading 60 points, 56, 57, 44. But again, it's very, very odd. And what you see here that I've been tracking since the June bottom, we're having these 2.5%, 3%, 1%, 1%, 1.5%, 2%, 2%, to almost 3% days, and we've only had two big drops of 1%, 1% back here in July, and another one here in July. 2 days in July, we dropped 1.15% on the day. But here we are, since we left the bear market bottom over here on July 18th, we're up here running. But again, going back to that point that I was trying to make before, on the second day of the year, we posted the high. On the 116th day of the year, we posted the low. 115 days in between that. It's been 38 days, and we've recovered more than 50% of that. It's been 21 days since we had that bottom there at 37.21, which again was our big buy the dip bottom. All that's happened here over these last couple of weeks is we've overextended where every bull had their top area being. Initially, it was somewhere in that 40-80 range, and we were due to get a dip, and then we were due to get the next rally. We never got the dip. Then it was somewhere into that 41.50, 41.60 area. We got that. We resisted it, and I'll show you on the charts. We had to gap over that area off of that CPI data that we got on Wednesday, which again on Wednesday we had a 58-point gap, but we only traded a 34-point range for the day. It's not that it's been a fantastic bull run that we can be able to trade, but we have now posted 4 consistent green weeks. 193 points, 229 points, 87 points last week, and now this week we got 168 points. We're up there at 420.80. We're obviously looking for another 20 points to get that gap filled that I'll show you in a minute. And here's the dips that we've had over the course of that run. 5.25% was that first dip. Then we had another 5% dip that took us to that 37.21, which we've now rallied 15 points, 15% off of that 37.21. That took 4 days for that 5% dip. Took 2 days for the other one. And here it is now, we're getting these dips, 1.3, 1.7. We can't get a dip strong enough to be able to go out and aggressively buy. And I'll show you again on the charts why this is some really scary stuff that's happening right now for anybody that's going to be continually exposed with the fear of missing out to the upside, because the upside has continued to remain very, very minimal. It's just that we're getting these news alerts that are giving us this gap up overnight, and then we're up into that next little boxing ping pong range of trading. But listen, I'm going to divulge for a second to go into my personal life before we go into the charts, because I've made a decision finally. I've got 5 weeks until I'm going to be 50 years old. It's going to be on a Thursday, September 29th. And I have decided that I am now, as of tomorrow, Monday, I am fasting. That's it. Until you give me a 5% dip on this market, I'm fasting. Excuse me. Apologize. I am fasting, and what I mean by fasting is I am going on nothing but water, no more coffee. I will be having 6 hard-boiled eggs. That's it. Only the egg yolks. Or I'm sorry, only the egg whites, not the egg yolks. So 465 calories, I'm expecting that to be quite a bit less, because I'm not taking in any of that cholesterol from the egg yolks, simply the egg whites. That's it. That is my food. I may steam some asparagus. That's it. Other than that, I will take 1 protein shake when I finish the gym, which will again be 2 scoops, so 50 grams of protein, 200 calories. So I'm basically going to be running off about a 700 calorie diet and nothing but water until we get that 5% dip. And that's the decision that I made. I made a decision very similar to this about 12 years ago when I had never been in the gym before, and I decided, you know what? I got to do this because look at what's happened to me. I've been living on the beach for 5 years, had absolutely no idea what a scale was, and I was about 280 pounds at this point. 9 months later, I was 180 pounds. I lost 100 pounds, but I joined the gym, and everything that I was doing was fitness. And as you can see here, this is obviously going back 12 years. That skinny little thing just didn't fit me. It didn't fit my body style, and I was a more of a heavy lifter anyway. This is me going back just a couple of months ago. I was doing 500-pound squats in the gym on a Wednesday. No big deal for me to rep these out. Times have changed. Going back about 3 years ago before I moved here, this is where I was in the gym every single day doing my deadlifts. And yeah, I had it. Yeah, I still had a little bit of a gut on me, but that was because I was more of a power lifter. Well, that's all got to change now because I'm sacrificing myself for the good of getting a proper dip to be bought. And I'll go over that as we get into it, but I'm going to stick here first off on the wide view and then start narrowing in onto the closer view and see how we progress as we go into this week. But here is your SPX on a weekly time frame, okay? And I want to point out here how the weekly has just pierced into the overbought warning levels. We've had it here many a time. Obviously, many times we've run up above this, but you have to remember as well, this was all COVID. And right after we had the September low right here, Joe Biden won. We went into that big wave three where the weekly stayed overbought most of the time, other than a tiny little fractional dip that we got back in June of last year. We had that wave four bottom, and then this was our wave five as we progressed over here. And we had that major sell divergence that you can see right here. And that was why we already knew we were due to be bearish going into the start of the year. We just didn't know that Russia was going to invade Ukraine and that it was going to be a lot more aggressive than it turned out to be, which is why calling the bottom became so difficult of a process for many people as we progressed after that March run, which is very identical to what we've got going on now, other than the fact that it took place over the course of 3 weeks. But then we got those 7 consecutive red weeks to the downside. And that is playing a part into where we are right now. And I'll explain it as we go into that shortly. We had those 7 consecutive down weeks, the 1 up week, and then 3 more down weeks as we went into that June low. And that's a major reason as to how we are where we are now above that 3950 area, above that 4080 area, above that 4120 area. And I'll show you over here, other than looking at the full stochastics, which are overly bullish, I want you to see here the chalk and money flow and how the chalk and money flow made a little bit of a pierce to the upside to be positive, and it's now turned negative. This is weekly. This isn't, a 5 minute or a 1 hour. This is a weekly chart, but you see here how your chalk and money flow has now started to show a little bit of a bearish sign as we were going into the month of August. Not something that's very positive out there. This is the SPX on the daily chart. Now, without drawing any trend lines, you can see this line straight over across here. It's just almost coming into contact here. And as you can see here, your September, October lows from back over last year. You can see here your January low. You can see here your March high. And that's exactly where we are right here, right in this distribution area. I watched a few videos over the weekend, and I see a lot of guys talking a lot of smack of a lot of different types of words. Bottom line, at the end of the day, the market is a video game. It is nothing more than a video game. It's properly calculated, and you can calculate where the projections are for the forecast of it, but you're only going to be right 80% of the time, and out of that 80% of the time, you're going to be 95% accurate on your timing of that 80%. So where we're at right now, we're in that 20% zone where the market's doing what it wants to do, and everybody that's out there, and they're all pounding the table going, ha! I'm winning. You bears are getting screwed. They're playing one contract. They're playing minimal, tiny, itty bitty positions because they're scared as well, because they know what's coming up here. And what's coming up here is nothing but an extreme stretch of what can only be tokened as, since we broke over this 4177 and above that 4115 area, as a super squeeze. Going back to that weekly candle where we were down 7 weeks, up 1 week, down another 3 weeks, that is where this is coming into play right now. I'll show you in a minute how that works out. Again, on the RSI here on the daily, we're up at 85 and a half. Starting to get a little bit of a divergence on the full stochastics. But again, looking over here at your chalk and money flow, your money flow peaked here at the end of July, and it's been doing nothing but fading down lower every single day as this impulsive move is completing. Here on the NDX, looking at the weekly starting to show signs over here of being overbought. Very similar that we had seen in other times back previous. Again, considering this is a very biased chart when looking at these RSI levels, because we had the big COVID bottom, and then you had no reason to do nothing but throw all the free money that was being thrown out there, the millions and millions of brand new investors that had nothing to do because they were sitting at home. So you do get a very extended view here on the overboughtness that just continued to run overbought, because at that time there was nothing to do, and you couldn't get worse than you already were, because we had just come from being completely shut down. So, again, but when you come over here and you start looking at these oversold weekly lines, you need to go over here and really give yourself an aggressive check and say, is this for real that I should be 80% long on my portfolio right now? And my answer to that is 1,000,000% no. Absolutely not no. And again, coming back here over to the money flow, looking at the money flow situation, how again, money all left there in March and started to come back a little bit over here in June, July, and August to the flat line. But again, you can see it is starting to leave again over here on the NDX on the daily. And on the daily, again, we've got a divergence now in place on the daily, a negative divergence where the RSI was higher than it currently is, but price is higher than it formerly was. That's where we get our divergence, and we've obviously got the 200-day moving average coming up there. Excuse me. I apologize. But again, we're at this level here, this high right here for May, right here where we're capped out at, almost there to the June lows. So again, we're in that little zone. Full stochastics starting to get a little bit of a divergence on the full stochastics on the daily. But again, looking back at the money flow on the daily, the money flow peaked in July, and it's been doing nothing but fading off slowly as we've been going in here into the second and third week of August. The Dow Jones, strictly looking at the daily over here, and as you can see over here on the daily's almost up here at 90 on the RSI. Again, right up there, nearing over the 200-day moving average, pointing once again that when this bottomed in June, it never ever made contact with 20% from the all-time highs. A very similar situation as to what took place back in 2000 after the dot-com bubble burst. The NASDAQ broke down into all hell, but the Dow Jones held strong. And as we went in there to August in 2000, we finally faded out where we failed, and then the bear market into 2002 really started. And I'll pull up a chart on that and show that in a little bit. But stochastics, bullish with a divergence, bullish. But again, back on the money flow. Money flow continues to just flow off, flow down from that peak over there in July. A major concern as to where we are. But again, this is all going back to this area right here where you had your 7 consecutive weeks to the downside, which has only happened two other times since 2002. I think I even went back to 1987, and it only happened two other times where you had eight in a row. Six, you had four. Here we had seven. One green week, three red weeks after that, to where we put in that June bottom. But again, this is where we are, how we've gotten to where we are right now, because of the fact that we've got a squeeze taking place. And again, on the Russell has just been overbought embedded since the beginning of July. Nothing but overbought, getting absolutely squeezed back up above the 200-day moving average as of Friday. Squeezed with all hell behind it, getting squeezed. 162 up to 200, a 40-point move on a $16 stock, or on 160. That's almost 30 points this rally has taken place. The extension on it is enormous. Everybody and their mother is looking for it to pull back to around 187, 182. Everybody. Overbought up here on the daily. Money flow, not as significant as you see over there on the SPX, the Dow, and the NASDAQ. But again, once money all flows in, it has nowhere else to go but to flow out. And why the Russell, again, is one of those things that we're definitely going to be paying very close attention to. And it brings us to the VIX. The VIX here, looking at this on a weekly chart, you've had nothing but red weeks consistently here on the VIX. Nothing but red weeks. Nothing to see here on the full stochastics, but again, a big major hello on how the weekly is oversold. Very similar to how the weekly was oversold here back in August, July of 2020, where we had our first official dip, which is where everybody's calling the major one and the major two pivot, the major three pivot being where we topped out in December or in January of this year. Major four, from a bullish point of view, would be the June lows, which we still need to make sure do not get failed as we move forward. Looking over here at the VIX on the daily not wanting to get oversold, hanging very tough, a very clear and obvious little descending wedge that you've got going on here. No activity whatsoever. But the only lines that we've got to go by now are the April low over there at 1845, and then a major pivot, which is at 1811. 1811 we broke through and we were already below as we were going into the beginning of the year, but 1811 is a major pivot. It's been a major pivot since 2016. It's a major pivot to be watching, and we're very, very close to that. So again, one of those things that we want to be just paying attention to. Not that we want to be overly concerned about it, but we want to be paying attention that it is there to give a trigger, because every trigger that we've had on the VIX have just failed over the past week and a half. So that's what I've got here on this. I'll bring you now on to the big charts. And where I'm starting out with here is the SPX on the daily. And I've got it as clean as I want to keep it for the amount of detail that I want to discuss here, because Keltner channels don't matter on the daily for me. You had your peak over here. Rare occasion when we hit the peak over here on the daily back in November of 2021, and then we just faded off. That was after that major rally that we had there in October, which could and should have been what this is, but we had that major five, or sorry, that wave five to finish off major three, brought us up here to 48.1862 on the second session of this year. Here's your March highs. And as you can see, your trend line coming down here in red, we're just fractionally below that. But again, fractionally below that is another 50 points up. Another 50 points up is 10% from the all-time highs. Where we're looking at from a 50% retrace is right there, that 42.2775, which we visited on Thursday, and then we gapped up above it here on Friday after we got that preliminary University of Michigan consentment numbers, which 900 out of 100 times, or 900 out of 1,000 times don't mean anything, and the rare times that they do, you get what you got there on Friday, which I will point out there on Friday. I'll bring it back, and I'll you know what? I'll go in here and I'll do it right now. Right here, Friday. Right here on Friday, you could see it was dancing on the 50% retracement line, dancing right there. And right here at 10:49, we started to make a move up. And I don't know where it is. I will check. Do, 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 do. It was 11:36 in the morning. Right here, and there was a report out that President Xi and Biden would wind up meeting in November that it's being prepared for. And right around here, the market just decided, okay, that's it, we're going. And it never slowed down as it made that move up to the upside here towards the end of the day. Right after that news came out, literally from 12 o'clock onwards, right here, we had that little bit of a chop. These two candles, these two 1 minute candles, and this move up here off of this, nothing significant. There were no news, no headlines, nothing to go by. But again, because of where we're at and how this has been trading, you see here we got overbought. And when we sold off and got not sold off, but got oversold, it was because we went nowhere. We went nowhere for 5, 6 days. And that allowed these to go ahead and get oversold low enough that you could go ahead and have another news alert, and that was the CPI, and you had your rally, you had your pop. But yeah, coming off of this, Keltner channels got hit over here. This was the trigger, okay? This was the trigger back at the end of July as to getting short. The upper Keltner got hit, we're overbought. Okay, let's get short. Let's get a little ride down. And we didn't go anywhere. We didn't go anywhere. That whole time, we went nowhere. And then we had the FOMC or the other report that came out, the jobs report, and we decided to gap up on the jobs report after that. Nowhere. And again, it's one of those times when you are in the market, which will happen 3, 5 times out of every year, where nothing at all makes sense from a technical point of view, from a chart point of view, from a price action point of view, from a volume point of view. Nothing adds up, but the market decides to go and do what it's going to do. Same thing like when we were having that fall off on those 7 weekly drops. That never should have happened, but you just couldn't sustain anything out there. There was no bad news, but you couldn't get anything that could hold you up. Now, looking at this again, just coming at it from a view, everything that we did is overbought. And everything that we've done since this, going back here in July off that pop, it's done. It's just gone absolutely on its own. This being right here, the FOMC low, 39.67, which I'll show you on the next charts. This is what we're looking at, that I'm looking at, what I have on my screen zoomed in on a 1 minute time frame. This is 20-day, 1 hour. This is what I see when I'm looking at it during the day, right here. And, again, coming at this, or, looking at it from any kind of view that you want to look at, this move has just been absolutely ridiculous. This right here is your FOMC meeting low, 39.67. And this is also where a lot of bullish traders are looking to get long. Right here, this 39.67, 39.45 area, in this zone right here is where everybody's looking to get long, because this being a 1, should this fail and be a B, or this be the completed 1, and now we're going into our minor 2 of major 5, which will take us up to 5,000. Everyone is looking for this level down here to break down below 4,000, likely in this 39.67, 39.45 area, and then go and make the next move, rushing up to the all-time highs, or at least up into around 46.37, 46.70, which would again be somewhere around a 600 to 700 point run, which is where you want to be when you have an oversold daily and an oversold weekly together to give you that signal to go and get long. This right here is not a get long. This right here is nothing but playing with everybody's brains. I'm not complaining. I'm not. I'm really not. But we're over here above the 161, which was the perfect spot if you were going to go for the uber bullish. This 4180 was already bullish. Where that, again, come over here on the 161.8, this is where we should have been in right there, that 4111. 4111 would have been the perfect area for this to be the wave 3, and then we would have gotten our wave 4 down here to around 4,000. It failed. It just, right here in this zone, we didn't do anything. We didn't do anything for that whole week. And because we didn't do anything for that whole week, it allowed the charts to get oversold. And then we had this other move, which again should never have happened. But a lot of people talk about fighting the tape. A lot of people talk about, making emotional decisions because you're angry and you don't think that this should work. It's not that being angry or that shouldn't work. It's why I've explained in the emails as well. You want to ratio out your exposure. And specifically, like with me, I have one trade for this week, August 19th. That's the Google puts. The Google 120 puts that I got at $1.50 the other day. When they went to 250, I didn't sell them. I left it on the table because I like the chart. I like the downside. And I still am looking for around that 116 level to be hit as we go into this week. And I'll show you that in a minute. But without a doubt, we're filling this gap. This gap right here, 4,300, we're filling that gap. Whether we go up there to that 43.39, 43.61 area, I can't say that. I can't go out there and say, yes, we are going to go up here and hit this minus 10% level at 43.36. I can't. It's not there. And when that does, all these Fibonacci's for the retrace are going to have to be moved up, which right now we're right around 41.48, which that 41.37 would be the very bullish wave 4 little dip, so we can get another move to the upside somewhere up around that 100% off of the COVID lows at 43.83, and then go and make a dip down to the downside somewhere down into this area of around 200 to 300 points to the downside. It may be, it may not be. Right now, it is very, very overextended, very, very overbought. Come over here onto Apple. And again, with Apple, this 171 makes all the sense and all the calculated numbers, views, charts, forecasts, market value, everything to say you are extremely overbought, bro, and you need to start dipping. But again, you're not getting anything out of Apple. You've got a good 1, 2, 3, 4, 5. Where 5 ends is completely up to what it wants to do. It's already worth $2.5 trillion market cap. Who in the hell needs a brand new fucking iPhone? Don't know, don't care. 1, 2, 3, 4 gaps just to fill, just to come down here to this 151 area, which is a lot more reasonable. But more importantly, you got your 200-day moving average, your 100-day moving average, your 50-day moving average. All of them are bearish stacked, but moving to the upside. A retrace down to that 200-day moving average around 160 makes complete and total sense. Since I'm on this, I will go ahead and pull up Google. I am going to take a lot more time focusing on Google. The pricing on the contracts is fantastic. This chart is fantastic. I love it. I love everything about it. I love the ability to be able to play it on a weekly. This move that we've got, as you can see, the big gap up after earnings, boom, start moving up here to the upside after the split that took place. And here we are again, right at that 121, 122 area for a resistance tab. Pull out a little bit further on it. Yeah, you're going to get a lot of lines. But as you can see here, right here is your May highs, which is again where we're talking about coming up to over there on the NDX. So possibly get an extension up there to around 122, 123, and then we should see a dip down here to fill this gap around 116. So that's what I'm looking at that. Tesla made that move back up to 900. Tesla being just absolutely amazing, but come out here on the wider view, and you can see where we are. When we broke out of that wedge, we knew to get bullish, and the bullishness has gotten us right up there to that 50 retrace. Little bit of a dip, came right back to 900, which is a big pivot point. Try and pull you up the Tesla chart. 900 was the January highs from back in 2021. So you're looking at a big head and shoulders that everybody's been talking about, which I don't believe. But you've got your 200, you got your 200 day right there, your 100 day, your 50 day. Again, bearish stacked, but moving to the upside and already very overbought. Come back over here where I've already got everything set up. Look at it really quick. Here's your Tesla hourly 30-minute. Okay, let's look at the 4 hour. 4 hour coming upwards to the upside to where it would be around overbought. You've got that level over here around 940 that it continued to reject over here. Everything that wanted to go bad on Tesla had gone bad, and the bad news just keeps getting bought every single time. You just up over here into overbought over on the 1 hour, but again, right up here into this 900 level. You could very well see this as being an ABC. Now you've got an ABC to the upside, and now somewhere to an ABC to the downside, back around here to around this 821.790 area, and that should complete this wave, and then you could get your next wave to the upside to go and push for that 1,000. But again, I bring this to close on the VIX, the VIX, the VIX, the VIX, the VIX. And it's the only thing really worth watching right now, as long as you're limited in your exposure, unless you are being very aggressive in day trading in the buying of calls or in the buying of puts or in scalping of any positions. If you're selling credit spreads, not so much important to you that you're playing with the VIX, just being specific to the price action of whatever the asset is that you're selling the spreads on. But, again, coming back here on a wide view, here's your 1987 market crash. Here's your 2008 crash. And here's your COVID. But I'm going to bring you in here and just zoom right in. And here's the 30-day. I'll bring you out to the 90-day. And we've just had this decline consistently to the downside, where this was originally resistance. We had that big pop over here in June where we posted the lows, and now we've just been riding the same trend line to the downside. We broke my 2102 pivot earlier this previous week. We've got gaps that need to be filled to the upside, which will fill. They'll fill when they fill, but you're getting obviously very aggressively oversold here below all sorts of levels. And just to come on to that concept right there alone, in talking about gaps, right? Here's where we are, okay? And here's our June lows. And we've got 1, 2, 3, 4, 5, 6, 7 gaps. 8, actually. Yeah. Wait, give me a minute. Yeah. Yes, I didn't update this on Friday because I was having delays with my Thinkorswim. And here's what we've got. We've got 1, 2, 3, 4 gaps, 5 gaps, 6, 7, 8 gaps below going to the June lows. We had 23 gaps when we posted the all-time highs in January. And of those gaps that we've had from there in January, we filled all of them except for these. We've still got these gaps here. 1, 2, 3, 4. No, that's not a gap. 5, 6, 7 gaps going back to here. Right there in that zone. Come on. Right here in this zone to 3,200. 3,505 being the 50 retracement of the COVID drop. Almost got down to that. Still got these gaps here, and then these gaps over here will be left alone until there actually is a confirmation that we are undoubtedly in a very aggressive bear market that is going to take a couple of years. But since we're there and we are discussing that, I'm going to go out here again and finish you off with this. 2002. Right. And here was our .com. We posted the .com highs here in March. Had our 13.75 over 15 sessions dip. Went over and wedged all the way here into right around September 1, end of August, for a failed fifth wave, and then began our decline to the downside. This right here is September. September. Excuse me. I'm sorry. Here's your September 11th. Here's your big rally after that, and there you go. So, again, something very similar. And come back over here onto where we revisited the .com highs back in 2007. Doesn't look anything the same going up to it, but the way down is very similar to where we are. And right around here is where we are right now in terms of our chart. Again, not using the charts to aggressively forecast and say what we're doing, where we're headed to. But yeah, right around here, sorry, not here. Right around here is where we're at right now in terms of our chart. So yeah, it is a little bit of a concern as to whether or not, we've completely finished off this bear market dip. But I will definitely say where we're going for right now, it's the same conversation. You gotta wait for the dip to get bought. We wanted to buy this FOMC dip, we never got it. We wanted to buy another dip that we had on another day over here, and it never arrived. It never showed up. So, these dips that we're not getting are forcing people to change their attitudes and say, "Oh, forget it. I'm done. I'm just going to buy." And it could work out. Could work out for a day. Could work out for 2 days. Could work out for a week. Could work out for 2 weeks. And then the moment's going to come where it's going to wipe all of that out and a little bit more, because it's going to have become an attitude rather than an actual respect for what's there and what's in front of you and what's actually happening. Because again, you got to remember, it's a video game, and the video game is made there to take your quarters. It's made to take your money so that you put another quarter in and you play again, and you put another quarter in and you play again. And again, I have two trades. I have the Google 120 puts for this week, and I have the SPY 418 puts for September 16th. That's all the exposure that I have, and I'm not adding anything to this. On Friday, I decided to throw $300 out for a dip. Never got it. So, this isn't something that you want to be playing around with if you're not ready to actually take the beating, because this thing has obviously shown to itself that it doesn't care. It has absolutely no emotions, and it has no fear. It has no happiness. It has no joy. It's only going to do what it's programmed to do. But going back, which I forgot to mention, and I apologize for this having been long-winded, why we are up here above this 4136 up into this zone where we've been for the last 3 weeks all goes back to this. It all goes back to this right here. This right there. This whole 7 week drop and then the other three was everybody getting short into the Septembers, because the money doesn't go short on weekly expirations. Money goes short further out. And everybody getting short on this dip over here, and the VIX having had that spike, now all it's doing is it's just a big short covering. That's the only thing that's buying any of this. That's why the money flow has been so horrible when you go over and you start looking at your technicals and you see there's nobody buying this. And that's exactly why it's happened. Again, when, these things will happen 3-5 times every year, and when they do, they absolutely fucking suck. But when they're done, It's nothing but a playground, and you're ringing the cash register. And I very much look forward to this week being an opportunity where we're going to be able to do that every single day. I apologize for taking up too much of your time. I'll go hit the gym tomorrow and, do it like I always do. But, I'm fasting. That's it. No more food for me. See you guys tomorrow.